Most people believe intelligence creates wealth. They scan business magazines looking for the next brilliant investment strategy. They're asking the wrong question entirely. The real question isn't how smart people get rich. The real question is why smart people stay poor. And the answer has nothing to do with IQ scores or business school degrees. 60 years of studying wealth reveals something that contradicts everything taught in economics classes. Rich people don't succeed because they're smarter. They succeed because they avoid stupidity more systematically than everyone else. Bankruptcy courts are filled with doctors, lawyers, and engineers who lost everything. These weren't stupid people making stupid decisions. These were intelligent people who never learned the difference between being smart and not being an idiot. The most successful investors approach wealth through inversion, a mental model borrowed from mathematics. Instead of asking, how do I get rich? They ask, how do I avoid staying poor? Instead of seeking brilliance, they catalog stupidity and avoid it ruthlessly. This approach has built some of the most successful investment records in history. The greatest returns don't come from genius stock picks. They come from systematically avoiding the errors that bankrupt everyone else. Here are 5 investments that compound wealth, not through brilliance, but through the elimination of stupidity. These aren't stocks or bonds. These are mental frameworks that prevent the catastrophic mistakes that destroy most people's finances. The first investment is building an ignorance inventory. Successful investors don't win because they know everything. They win because they know exactly what they don't know, and they stay far away from it. This concept is called the circle of competence, not a circle of interest, not a circle of curiosity, a circle of genuine, deep, defensible competence where decisions can be made rationally. In the 1,990 seconds, technology stocks were creating millionaires overnight. Analysts screamed, buyeverything.com. Fund managers who ignored tech stocks got fired. The pressure to participate was enormous. The wisest investors sat out the entire tech boom, not because they hated technology, not because they didn't understand it, because technology fell outside their circle of competence. They couldn't predict which companies would survive. They couldn't evaluate competitive advantages in industries changing monthly. They couldn't distinguish between durable businesses and temporary fads with any confidence. So they did the hardest thing possible in a bull market. They did nothing. They bought boring businesses like furniture stores and brick manufacturers while everyone else was buying pets.com and Webvan. People called them dinosaurs. Analysts said they'd lost their edge. The media wrote articles about how the old guard didn't understand the new economy. Then the tech bubble burst. Trillions evaporated overnight. Those genius investors went bankrupt, and the boring businesses kept printing cash after decade. The money not lost by staying inside the circle of competence proved worth more than any money made gambling outside it. Here's what separates people who build wealth from people who destroy it. The wealthy know their boundaries with precision. They draw a circle around what they genuinely understand, and they never cross that line no matter how tempting the opportunity looks. Most people do the opposite. They see an opportunity in real estate when they understand software. They invest in cryptocurrencies when they understand manufacturing. They chase returns in fields where they have no competitive advantage, no deep knowledge, no ability to evaluate risk. This isn't caution. This isn't fear. This is rational self-assessment. It's understanding that outside your circle of competence, you're not investing, you're gambling, and the house always wins eventually. The action here is brutally simple. Take 30 days and make a list of 3 things you genuinely understand at a deep level. Not things you're interested in, not things you've read articles about, things where you could teach a university course and defend your knowledge against experts. Then make a second list of every investment, business decision, or financial choice you've made in the past 5 years. Compare the lists. Every decision outside your circle of competence probably lost money or performed below market averages. This exercise is painful. Most people discover their circle of competence is tiny. That's not a weakness. That's clarity. Wealth is built inside that tiny circle, not by expanding into territories where you have no advantage. The second investment is building a failure collection. The fastest way to get smart about money is studying stupidity in detail, not success stories, failure stories. Success has 1,000 fathers, and every winner claims their victory came from brilliance. But failure is honest. Failure shows exactly what went wrong, and the patterns repeat across centuries with remarkable consistency. The greatest scientific minds understood this principle. Darwin spent more time trying to disprove his own theories than proving them. He collected every piece of evidence that contradicted his ideas, studied it obsessively, and only accepted his theory after he'd exhausted every possible criticism. Most investors do the opposite. They collect evidence that confirms their beliefs. They read articles that agree with their investment thesis. They seek out analysts who validate their decisions. This is called confirmation bias, and it bankrupts more people than market crashes. Here's the approach that builds actual knowledge. Study every major bankruptcy of the past 50 years, not the success stories plastered across business magazines, the catastrophic failures that destroyed billions. Enron, Lehman Brothers, long-term capital management, Theranos, WeWork. These weren't small mistakes. These were intelligent people with Ivy League degrees making decisions that destroyed everything. What patterns emerge? Excessive leverage appears in almost every major bankruptcy. Companies borrowing too much money, amplifying returns on the way up, and amplifying destruction on the way down. When the cycle turns, leverage transforms small problems into existential catastrophes. Accounting fraud shows up repeatedly. Not necessarily illegal fraud, but creative accounting that hides reality. Revenue recognition tricks, off-balance sheet entities, adjusted EBITDA that adjusts away all the important costs. When companies get creative with numbers, danger follows. Charismatic leaders with no oversight destroy companies regularly. One brilliant person with no checks, no dissenting voices, no board willing to challenge decisions. Elizabeth Holmes at Theranos, Adam Neumann at WeWork. Unchecked confidence plus capital equals disaster. Ignoring fundamentals in favor of stories bankrupts investors constantly. Companies with no profits, no path to profitability, but beautiful narratives about disruption and revolution. The story works until it doesn't, and the collapse is always sudden. Here's what to do with this failure collection. Create a document titled Ways I Will Not Be Stupid. List every pattern of failure you've studied. Then, before every significant financial decision, check your choice against this list. Am I using leverage? Am I believing accounting that seems too good? Am I following a charismatic leader without questioning? Am I buying a story instead of analyzing fundamentals? If any answer is yes, walk away regardless of how good the opportunity looks. This framework has saved fortunes by preventing catastrophic errors. It doesn't maximize returns. It prevents the total losses that make recovery impossible. And over decades, avoiding catastrophic losses produces better returns than chasing maximum gains. The third investment is creating a bias budget. Human brains are prediction machines optimized for survival in small tribes, not for making rational financial decisions in complex markets. Understanding this prevents expensive mistakes. There are 25 documented cognitive biases that destroy wealth systematically. These aren't personality flaws. These are hardwired brain functions that work perfectly for survival on the African savanna and fail spectacularly in modern markets. Social proof bias makes people buy stocks because everyone else is buying. When neighbors are getting rich, flipping houses, the brain screams, "You're missing out." This drove every bubble in history, from tulips to dot-coms to cryptocurrencies. Commitment and consistency bias makes people defend bad decisions instead of changing course. After publicly announcing an investment, the brain refuses to admit error. Investors ride stocks down to zero rather than accept they were wrong. Depribble superreaction syndrome makes people overvalue what they already own. Homeowners think their house is worth more than identical houses on the same street. Business owners refuse fair buyout offers because losing what they have feels worse than gaining something better. Availability bias makes recent events feel more important than they are. After a market crash, people think crashes happen constantly. After a bull market, people think stocks only go up. Recent memory overwhelms statistical reality. These biases don't disappear with education. PhDs fall victim just as easily as high school dropouts. Intelligence doesn't protect against cognitive biases. Only systematic processes that acknowledge and counter these biases provide protection. Here's the framework that works. Before any significant financial decision, run through a checklist of questions designed to expose bias. This isn't optional. This is the difference between rational investing and expensive gambling. Question 1. Am I buying this because others are buying it? If yes, stop. Wait 30 days. If the thesis is sound, it will still be sound in 30 days. If the only reason is fear of missing out, that's social proof bias talking. Question 2. Have I publicly committed to this position? If yes, find someone who disagrees and pay them to argue against your position. Actively seek disconfirming evidence. Prove yourself wrong before committing capital. Question 3. Am I overvaluing this because I already own it? If you didn't own this asset right now and someone offered it to you at the current price, would you buy it? If no, sell it. Ownership shouldn't change valuation. Question 4. Is my judgment being warped by recent events? Look at 10-year data, not 10-day data. What looks obvious in the moment often looks absurd in historical context. Zoom out before committing. These questions feel tedious. They slow down decision-making. They prevent action when action feels urgent. That's exactly the point. The bias budget protects you from your own brain's worst instincts. The fourth investment is accumulating patience premiums. The financial industry is built on the assumption that action creates value. Trading generates commissions. Advice generates fees. Activity generates revenue for everyone except the investor. The data shows the opposite. The most profitable investors make few decisions. They find excellent businesses, buy them at reasonable prices, and then do nothing for decades. The returns come not from activity, but from compound interest working uninterrupted. Berkshire Hathaway's investment strategy has been described as sit on your ass investing. Find wonderful businesses at fair prices, buy them, and let compound interest work. No trading, no market timing, no clever strategies, just patience. This approach seems too simple to work. It violates every instinct developed in modern markets. When stocks drop, the brain screams sell. When stocks surge, the brain screams buy more. Constant activity feels productive. Doing nothing feels lazy. But mathematics doesn't care about feelings. A stock returning 15% annually turns $100,000 into $400,000 in 10 years. The same return over 30 years turns 100,000 into 6,600,000. Patience doesn't just add returns. It multiplies them exponentially. Most investors never capture these returns because they can't sit still. They sell winners too early. They buy losers at the wrong time. They trade in and out based on news, feelings, or tips from friends. Each trade erases a little more compound interest. The data is brutal and clear. The average investor earns roughly 3% annually, while the market returns 10% annually. The difference isn't market access or information. The difference is behavior. The 7% gap comes entirely from impatient decision making. Here's what this means practically. If you invest in a quality business or index fund, your job is to do nothing. Not to monitor it daily, not to trade based on news, not to optimize and adjust constantly. Your job is to sit on your ass and let time work. Set a rule right now. Any investment you make must be held for a minimum of 5 years, unless the fundamental thesis changes. Not unless the price drops. Not unless better opportunities appear. Unless the core reason you bought it is no longer true. This rule will feel impossible to follow. Every day, the financial media will scream reasons to trade. Every month, new opportunities will seem more attractive. Every year, market crashes will make selling seem smart. Ignore all of it. The patience premium compounds at roughly 7% annually, the difference between active and passive investor returns. Over 30 years, that 7% difference means more wealth than most people accumulate from their career earnings. The fifth investment is building a simplicity standard. Complexity doesn't create value. Complexity hides risk. The most dangerous investments are the ones that require PhD mathematicians to explain them. When brilliant people at Long-Term Capital Management nearly destroyed the global financial system in 1998, their strategy required Nobel Prize-winning economists to understand sophisticated models, complex derivatives, mathematical formulas most people couldn't read. It all collapsed in weeks. When Lehman Brothers went bankrupt in 2008, their balance sheet was so complex that regulators couldn't figure out what they owned until months after the collapse. Complexity made oversight impossible. Complexity made risk invisible. Complexity enabled catastrophe. The most durable fortunes come from simple businesses. Businesses so simple that an idiot could run them, because eventually an idiot will. Coca-Cola sells sugar water. See's Candies makes chocolate. Geico sells car insurance. None require genius to understand. Simple businesses have predictable economics. Revenue comes from identifiable sources. Costs are straightforward to calculate. Competitive advantages are easy to evaluate. Risks are visible and manageable. Simplicity makes rational analysis possible. Complex businesses hide everything. Revenue comes from 17 different streams with different accounting treatments. Costs depend on assumptions about future events. Competitive advantages rely on proprietary technology nobody can evaluate. Risks are buried in footnotes written by lawyers. When you can't explain a business to a 12-year-old in 3 sentences, you don't understand it well enough to invest in it. This isn't an exaggeration. This is the standard that prevents catastrophic mistakes. Here's the test for every potential investment. Explain it to someone with no financial background. If they understand it in 3 minutes, it passes. If they're confused, you don't understand it either. Walk away. This standard eliminates most investment opportunities. Cryptocurrency strategies? Too complex. Structured financial products? Too complex. Private equity funds with multiple layers? Too complex. 90% of what Wall Street sells fails this test. That's not a bug. That's the feature. Eliminating 90% of potential investments isn't missing opportunity. It's avoiding catastrophe. The greatest returns come from the 10% of opportunities simple enough to analyze rationally. The action here is establishing a complexity filter before capital deploys. Write down the investment thesis in 3 sentences. No jargon, no technical terms, no acronyms. If the explanation requires more than 3 simple sentences, It's too complex. Then explain it to someone outside finance, a family member, a friend, a neighbor. If they don't immediately understand how the business makes money and why it's valuable, neither do you. Reject the investment regardless of projected returns. This filter will make you seem unsophisticated. You'll miss investments that sound brilliant at cocktail parties. You'll avoid strategies that make people feel smart. You'll say no to opportunities that everyone else is chasing. Good. The sophistication that impresses people at parties is the complexity that bankrupts them later. Simple businesses that seem boring are the ones printing cash decades after complex strategies have collapsed. These 5 investments work together as a system. The ignorance inventory defines boundaries. The failure collection identifies patterns to avoid. The bias budget counters irrational thinking. The patience premium allows compound interest to work. The simplicity standard prevents catastrophic complexity. This isn't a strategy for maximizing returns. This is a strategy for not being stupid. And over decades, not being stupid produces better results than being occasionally brilliant. Most investment advice focuses on what to buy, what stocks look promising, what sectors are growing, what trends to chase. This is optimization thinking, trying to find the best possible choice among thousands of options. Inversion thinking asks the opposite question. What definitely shouldn't be bought? What patterns lead to disaster? What behaviors guarantee failure? Eliminate those, and what remains doesn't need to be brilliant, it just needs to be not stupid. The mathematics are simple. Avoiding catastrophic losses matters more than capturing maximum gains. A 50% loss requires a 100% gain just to break even. One catastrophic mistake can erase decades of careful gains. This is why the wealthy focus on downside protection first and upside potential second. They ask what could go wrong before asking what could go right. They structure decisions so that errors are survivable and successes are scalable. Here's what this looks like practically. Before buying any investment, list everything that could cause it to become worthless. Competition, regulation, technological change, management fraud, accounting errors, market crashes, every risk that could lead to total loss. If any risk on that list seems likely, walk away immediately. If the risks seem unlikely but would be catastrophic, size the position so the total loss wouldn't be devastating. Never bet amounts that would be life-changing to lose, only amounts that would be life-changing to gain. This approach seems conservative. It is. Conservative beats aggressive over long time periods because conservative survives the inevitable disasters that destroy aggressive portfolios. Survival isn't exciting, but survival compounds into wealth. The implementation timeline is straightforward. Next 30 days, build the ignorance inventory. Define the circle of competence with precision. List 3 areas of genuine expertise and commit to staying inside those boundaries. Months 2 and 3, build the failure collection. Study 5 major bankruptcies in detail. Document the patterns. Create the list of ways not to be stupid. Review it before every financial decision. Months 4 through 6, implement the bias budget. Create the checklist of questions that expose cognitive bias. Use it religiously before any significant commitment. Track decisions that bias would have made and compare them to rational alternatives. Months 7 through 9, establish the patience premium. Set the 5-year minimum hold rule. Calculate what compound returns look like at current savings rates over 30 years. Internalize why doing nothing is the highest value action. Months 10 through 12, enforce the simplicity standard. Review current investments against the 3-sentence test. Eliminate anything too complex to explain simply. Commit to never investing in anything that can't pass this filter. This timeline isn't aggressive. It doesn't promise fast results. It doesn't generate excitement or dramatic wins. It builds a system that prevents the catastrophic mistakes that destroy most people's wealth. Over 1 year, this system seems boring compared to active trading strategies. Over 10 years, this system produces returns that beat 90% of active traders. Over 30 years, this system creates the type of wealth that seems impossible from the outside. The difference between rich and poor isn't intelligence, work ethic, or even opportunity. The difference is systematic avoidance of stupidity. Rich people don't make fewer mistakes because they're smarter. They make fewer catastrophic mistakes because they have better systems. These systems aren't complicated. They're not secret. They're not even difficult to understand. They're just difficult to follow because they require patience, discipline, and the willingness to be boring while everyone else is being exciting. But boring compounds. Boring survives. Boring accumulates into wealth, while exciting oscillates between euphoria and catastrophe. The choice isn't between smart and stupid. The choice is between systematic and random. This framework won't maximize returns in any single year. Some years, active traders will beat it. Some years, complex strategies will outperform. Some years, risky bets will pay off spectacularly. None of that matters. What matters is the compounded result over decades. What matters is avoiding the blow-ups that make recovery impossible. What matters is still being in the game when everyone else has been eliminated by their own cleverness. The wealthiest investors aren't the ones with the best years. They're the ones with no catastrophic years. They're the ones who compound steadily while others oscillate wildly. They're the ones who survive long enough for time to do its work. This isn't inspiring. It's mathematical. It's not exciting. It's effective. It doesn't promise fast wealth. It promises durable wealth that lasts generations instead of evaporating in the next crisis. The question isn't whether this approach works. The data proves it works. The question is whether you can follow it, whether you can be boring when everyone else is being exciting, whether you can do nothing when action feels urgent. Most people can't. That's why most people never build significant wealth, despite living in the wealthiest period in human history. They have the information. They lack the discipline to apply it consistently. If you implement these 5 investments starting today, your financial life will look completely different in 10 years. Not because of brilliant wins, because of avoided stupidity. Not because of perfect decisions, because of eliminated catastrophes. The framework is simple. Know your boundaries and stay inside them. Study failure and avoid repeating it. Counter cognitive biases systematically. Let compound interest work uninterrupted. Keep everything simple enough to understand completely. Simple doesn't mean easy. Following this framework while watching others get rich quick will test every instinct. Staying patient while markets crash will feel impossible. Maintaining simplicity while complex strategies sound sophisticated will seem unsmart. Do it anyway. Not because it feels good. Because mathematics doesn't care about feelings, and time proves mathematics right eventually. The only question is whether you'll still have capital when time proves you right, or whether stupidity will have eliminated you first. Most people discover this truth too late, after they've already made the catastrophic mistake that wipes out decades of accumulated wealth. They understand the principles perfectly in hindsight, but hindsight doesn't restore lost capital. The investors who survive aren't the ones who never feel tempted to be stupid. They're the ones who feel the temptation and resist it anyway. They watch others get rich quick and choose to get rich slowly. They endure the pain of missing out on bubbles to avoid the catastrophe of participating in crashes. This is the difference between knowing what to do and actually doing it. Everyone knows they should avoid stupidity. Few people actually build systems that prevent it. Even fewer follow those systems, when emotions run high and peer pressure becomes overwhelming. The framework laid out here isn't theoretical. It's been tested across